It's a new day, and finally got to see the report from Nvidia
Yeah, the
last week.
long-awaited report.
Yeah, and it was impressive, but there's always a but with a stock that had so much expectations coming into last week. In fact, the expectation was out of this world. But that is what you expect for a stock that's risen 186% year to date. And we didn't see only results from Nvidia. We saw Snowflake. We saw, which other company did we see?
Medtronic,
Yeah,
Alto.
Palo Alto. Yeah, and we had some interesting reports from those guys. Now, but before we get into the discussion of the day, for investing can be simple and difficult at the same time. Simple in the sense that it just the asset classes out there you can put money into, but difficult when it comes to actually doing it. And you think of what is going on today. We have stocks globally doing very well. US stock market has risen about 25% year to date. The Nigerian stock market has done 30% year to date. Crypto, Bitcoin is nearing $100,000. One Bitcoin is nearing $100,000 currently. Bitcoin used to be just recently in 2021, 2022. It came down to about $30,000. But today, following the victory of Donald Trump, the crypto market is doing extremely well. And even the fixed income market, we're seeing yields as high as the last auction closed pretty high. So for an investor, it's really could be challenging, trying to decide on where to put money when you consider all of this. And that leads us to something interesting that I want us to talk about today, which is the 60-40 rule. So it's another episode of Market Tape on Street Exchange, and this is your every Monday show to help you stay up to date with the Nigerian and global capital markets. It's a show you never want to miss, so make sure you are dialed to our channels. Every week, every Monday, we'll hear. And as we always do, this show is for information purposes only. It's not an investment advice. It's not a solicitation to invest or buy any security. Everything we do here must be considered in the view of your personal circumstances, and make sure that you get professional guidance before putting them to use. So, before we get into Nvidia, let's talk about the 60-40 rule.
Yeah, the 60-40 portfolio.
Yeah.
Like you said, investing can be as easy as saying just put in money. Crypto is doing almost $100,000 levels. Yields are high. It could be as simple as that, but it also needs some sort of strategy. People need to have to implement a strategy. That's where this 60-40 portfolio rule comes in, where there's some sort of diversification when one is building their investment portfolio. And the diversification also helps people spread their risk across different asset classes. So if, for instance, yields start coming down, the bond portfolio, the stock portfolio could make up for the decline. So that diversification is very, very important. So now when we talk about the 60-40 portfolio, we're looking at a mix of stocks, bonds. Let's first of all focus on on bonds.
Bonds, yeah.
Yeah, let's focus on bonds.
Speaking of bonds, I think we saw the DMO auction bonds last week.
Yep.
And treasury bill at the same time. And it would be nice to set the context from these events last week. I'm sure you have those reports for us.
Yes,
for
I
the
do.
Bond and treasury bill auction.
Yeah.
Closing pretty high.
Yeah, the bond auction, the FGN bond auction. So it was a with 2029 and 2031 bonds, and the 2029 closed at 21%, and 2031 closed at 22%, which
This
is
is about the highest we've seen for
yeah,
for the 2031 bond and 2029 bond. This is about the highest
true.
levels they've closed.
Yeah,
Maybe in
so
the history of the Nigerian debt market.
debt markets.
Yeah.
Same thing with the treasury bill. We saw the auction last week, and the 91-day closed at 18%. 182-day closed at 18.50%, and the 1-year T-bill closed at 23.50%. Just when we
23
thought we
points.
had seen, just when we thought we had seen the highest rates in the market, we see 23.5%. So with these high yields or high rates, what role these sort of rates could play in one's portfolio when we're talking about the 60-40 portfolio?
I think for me, when it comes to investing, it's about seizing moments. Back in 2022, we saw a situation where the bond market and the stock market both were declining at the same time. In Europe, developed markets, fixed income rates came as low as close to 1% at some point. In fact, from 2020 to 2021 up to 2022, we're already talking about a zero interest rate environment. I think late 2021 stroke early 2022, even the bond market in Nigeria was almost 1%. So at that point, people started to talk about the notion that the so-called 60-40 rule, which is having 60% invested in stock and 40% in bonds, was becoming obsolete, was going to be a thing of the past. But with inflation surging globally, everything has changed. So today we are seeing rates reaching this sort of level in emerging markets. In Europe, in US, for instance, the current 10-year yield is around 4%, which is pretty high for a developed market. So for me, building wealth is about seizing the moment. And moments like this, you want to make the most out of the opportunities that we have. I mean, locking in 22% for a 2031 bond, which is 7 years bond.
Yeah.
In fact, the 2034, you can also get it around 20%. So locking in 20% for the next 10 years would I think change the dynamics for any portfolio.
Yeah.
In terms of, I always speak about building wealth for the long term, not short term. So if you're a long-term investor, if you're someone who wants to build wealth over a long period of time, then you should you will look at this rate and see it as a golden opportunity to seize the moment. And then, like I said, if you look at Europe, US, the current 10-year yield is around 4%. Canada is 3.38%. The Eurozone is 2.9%. Germany is 2.3%. And Japan is always known to have this sort of very low rates. Japan is currently at 1.1%. But for this developed market, these rates you're seeing are actually very high.
Yeah.
And you may not appreciate it, but if you are somebody who has amassed a lot of wealth over the years and you are looking for safety, getting a 4% in a market like the US market will be very impressive. And then you mix that up with whether you are trying to get 11% on the S&P 500 or the sort of rates that you can get from the emerging market like Nigeria from stocks. It will literally change the dynamics for any portfolio going forward.
All right. So if we're talking about allocation currently, it's easy to say 60-40, right? Mm-hmm. But when it comes to allocating these stocks, we're talking about global stocks, right? So looking at stocks trading on the New York Stock Exchange, then looking at also adding in, as Nigerians, also adding in probably Nigerian stocks. And then we're looking at bonds. You talked about the US markets like the developed markets, like the US. How to allocate, do some allocation to that, and also considering rates in Nigeria currently. So it's a lot. So how does one properly allocate all of this?
Yeah, so for me, when it comes to investing, the first thing for me is to take out the noise. If you look at the current dynamics, it's easy to get confused. Do I do crypto? Do I do stocks, Nigerian stocks? 30% is impressive. Do I do foreign stocks? 25% in foreign currency is impressive likewise. So for me, it's to take out the noise. And the noise is to weigh less current events. Because as human beings, we are often bogged down by recency bias. We think of what is happening today. And that is what most people account for the most when they are taking investment decisions. So for me, the way to take out the noise is by looking at historical performance. Yeah. And that is always the guide you want to have as an investor. So if you look at the long-term performance over the last 10 years, you see the S&P 500 has done better than virtually every market in the world.
Yeah, I think year to date 25%.
I'm speaking of the 10 years long performance for the S&P 500. 247% over the last 10 years the S&P 500 has done. The next best market is the Indian MSCI India total return, which is 128%. Then you have Japan, 82%. Then you look at the Nigerian stock market, impressive return. If you're looking at it from the local currency point of view, if you're looking at the Naira return of the Nigerian stock market over the last 10 years, 82.1%. But then if you look further down, looking at the Nigerian performance, not in terms of the local currency, but in terms of the US dollar, in terms of the foreign currency, which is the metric with which we are looking at all of this, the currency with which we are looking at all of these other performances, the Nigerian stock market is the worst, negative 80%, 80.93%. And so you have all of these other markets, Europe, 67%, Germany, 55%, China, 24%. So by a long stretch, the US market, to me, if you're looking at a global investor, for me, the US market is the basis for a global portfolio. It's your core, if you use that word. It's your core, is the core of any global portfolio. On that core, you can now add some of these other markets in some proportion. So for me, I'm tilting a lot more towards the S&P 500, and I could add some Asian markets, especially India and Japan, to that, and then of course some Nigerian companies. But how you select this now depends on your risk appetite, your risk tolerance, the weight. But the first thing I will overweight if I'm constructing a global equities portfolio is the S&P 500, which is basically the largest companies in the US. That is the first thing I will overweight for a long-term portfolio. On this I can now add other layers, depending on your objective and how much risk you are willing to take.
So risk is also an important factor to consider.
Of course.
Because at the end of the day, you don't want to make an investment where you can hardly sleep at night. So you must know what your risk appetite is. Are you the conservative investor? Are you the growth-seeking investor? You have to know where your risk appetite falls under to be able to properly select these investments. Now, I think I was interested in Nigeria's performance that was negative. What was the exchange rates that was used to?
Well, I'm not sure. This is MSCI, Morgan Stanley Capital Index.
Okay.
I'm not sure. So it's not a single exchange rate. So what they do is they show your performance in your local currency and also show your performance in a foreign currency. So different investors can compare. So if you're a Nigerian who is investing in Naira, you may not bother too much about the local currency return. But if you're a foreign investor, let's say you're in New York and you're investing in the Nigerian market, you don't care so much about the return in naira. What you
Yeah.
care most is what you get back in
In
dollars
dollars.
at the end of your investment horizon.
Yeah.
That is what you care most about. So this doesn't look good for somebody who is in New York and is looking to invest in the Nigerian stock market. And that kind of explains why you've seen the FPI participation in the Nigerian stock market dry up a little bit,
Yeah.
you know.
While we're on the topic of exchange rates, right? So I think another thing to consider, especially as Nigerians living in Nigeria, and we've established the fact that we're dollar
dependent
economy, right? So whatever you're making in naira, you have to, by one way or the other, you have to look for a way to translate it to dollars, right? So I think one thing people would consider based on that is what the currency risk, right? We've seen naira depreciate by about 89% year to date when you look at the NAFEX rates. So that's one thing to consider. So where does that fall in when, constructing this 60-40 portfolio?
So first of all, let me even speak about the issue with, you mentioned the fact that our economy is dollar dependent.
Yeah.
And there's a lot of conversation we have about not dollarizing the Nigerian economy, but I think there's a lot of work that needs to happen.
Yeah.
It's not about the rhetorics alone. Anybody can wake up and say we shouldn't dollarize the economy, but you look at virtually everything we use in this country. Look at this mic, is imported. There is no. If I decide to use a made in Nigeria mic, will you find one? The answer is no. Our laptops, softwares, just every damn thing we use in the country is imported.
I think it's unrealistic when people say don't dollarize the economy. It's very unrealistic.
It's realistic. It's realistic, actually. I agree with you,
Unrealistic.
If you think of the current situation.
Exactly.
But realistic in the sense that if you put in the work, you transform your economy. And I spoke about India last week.
Yeah.
And this week you're seeing the numbers. India, next to the US, is one of the best performing best performing stock markets in the world over the last 10 years. And what is driving that? It's really how technology is driving the country. India gets a lot of foreign direct investment, healthcare, softwares. A lot of accounting softwares that you pay from Nigeria, you pay to India for.
Yeah.
People are sick, they go to India for treatment. So you have to deliberately create that type of scenario for your economy to thrive. Up to today, we haven't found a go-to product that we can sell to the rest of the world. Maybe entertainment would have been it for us.
Yeah, we're doing really well in that area. So.
But how much have we harnessed it? These musicians, let's face it, our comedians, they go out there, perform. Do they bring the money back to Nigeria? Most of these guys have foreign bank accounts.
True.
So when they go out, perform, they earn this money in dollar, they stash it abroad, they buy houses there. So until this money's find its way back to the country, we can't say we have a product yet.
True.
Yeah, but now to the core of the issue, so for me, if you're talking about the 60-40 rule, I would apply the same 60-40 rule in terms of currency allocation.
Yeah.
So if I'm thinking of constructing this global portfolio, and I'm a Nigerian, the base for me would actually be 60-40 for foreign currency assets, and then 40 for local currency assets. And thankfully, we have a lot of foreign currency assets in Nigeria, whether you're talking about Euro bonds. You have a plethora of them. The federal government recently issued what did they call it? A diaspora bond.
Domestic dollar bond.
Domestic dollar bond, yeah. And I'm also hearing that they're likely to issue a sukuk bond in USD. We talked about it last week. So you have some of these other assets in play in the country currently. So if I'm constructing a 60-40 portfolio, I'm also going to do the same 60-40 for currency. 60% of my investment in USD, and then 40% in the local currency.
Yeah.
Yeah. So I think that works. I mean, this is a basis. For some people it may be different. There are people who could have a different type of allocation. But this rule is, we have to put this out there, that it's not a one size fits all.
True.
And as I said at the beginning, nothing said there's an investment advice. Before you put any of these to use, you have to, of course, take into cognizance your own personal situation, your risk tolerance, your objective, your liquidity needs, and all of those type of things.
Yeah.
So
I think that part is very important, because I think people are prone to taking information like this and just, running with it. But it's important that what we're doing is just establish the fundamentals.
Yeah.
These are things you need to consider. So like you said, it's not a one size fits all.
At all.
There are a lot of factors you need to take into, what do you call it? Consideration when you're making these decisions. Very, very important. And if we, based on it, we've also seen a rave since the Trump election when it comes to cryptocurrency, both for Bitcoin and for altcoins. We've seen a rave. We've seen Bitcoin year to date. Bitcoin has moved from about, at the beginning of this year, it was at the 44,000 levels. And currently it's almost hitting the 100,000 level. And, so my question is, what role does alternative assets play? Because we've talked about bonds, we've talked about stocks. What role do these alternative assets play? Assets like also hedge funds, private equities. What role do they play in this portfolio?
Okay, so I'm tempted to say it's no role and some role at the same time. Because this whole idea around 60/40 is a classical type of portfolio where you just have stocks and bonds.
Yeah.
But stocks being a proxy for risky assets, and then bonds being a proxy for low risk, safer assets. So we can on one hand have 60% in bonds, 40% in bonds, and then on the other hand you have a 60% allocation to risky assets, which is stocks. But first of all, this whole idea is on the premise that this kind of portfolio is for moderate risk investors. So if you're a moderate risk investor, you're actually not going to look at asset classes like crypto favorably.
Yeah.
Hedge funds. These are riskier asset classes. So if you are riskier than stocks,
True.
even. So if you are a moderate risk investor, those might not be in play for you. And sometimes you hear people like a 55-year-old telling you, I want to invest in crypto.
That's where FOMO comes. The fear of missing out.
You shouldn't be doing that. You can't be 55 and talking crypto. Can you tolerate the risk? Of course, if you're a billionaire and you are 55, why not?
True.
Play the game. Have some fun. But if you don't have as much assets saved up already, and you're trying to build your wealth at 55, my thing would be avoid this riskier type of assets. But if you're a younger investor, you can now take your 60% allocation to stocks and probably do a 10 or 5% allocation to crypto, look at hedge funds. Of course, if you are young, you have the investment time horizon.
Yeah.
And especially if you are a high net worth investor and you are young, and you could consider some of these
taking on some of that
assets.
risk.
So we already established that it's not a one size fits all.
True.
Yeah, but so for each person, there comes all of these nuances on how to go about the actual construction of the portfolio, and that is where professional guidance comes in. You can't. For many people, they can't do it on their own. You have to speak to a professional. Only a few people who are not in this side of the divide would be able to handle it on their own.
Yeah. I think there was something you pointed out, something about age, right? I don't think a lot of people take that into consideration. A lot of people don't even factor that in when making investments, because it's very important. Age, of course, the higher your age, the less investment horizon you have. So it's always important to factor age in when making some investment decisions.
Yeah.
So it's very important.
Yeah.
Yeah. So if we move away from this, we can let's look at the earnings reports. Yeah. So let's start out with Nvidia. Last week we talked about Nvidia, what we were looking out for with the earnings reports, and one of the things we spoke on was the revenue. We spoke on, we're looking out for them delivering on analyst expectations, because that will somehow substantiate the claim that the AI demand has, been sort of tremendous. Now, if we look at their earnings reports, they surpassed analyst expectation by 5.9%. So their revenue stood at $35.1 billion. EPS surpassed estimates by 8.6%, and EBITDA 7.4%. Now, if we look at their revenue, generally it rose 94% on an annual basis. Now, my question is, it's some sort of how do I explain it? It's ironic, rather, that following the impressive performance, so to speak, their stock was down 3.2%. The stock was down 3.2% at close of market on Friday. So how impressive do you think this performance is, and why do you think their price went down?
With Nvidia, I think it's a game of expectations.
Yeah.
Nvidia has set a very high bar for themselves. Over the last 5 quarters, they have consistently beat expectations. So we did say we're hoping that the company will beat expectation. The expectation coming in was 33.1 billion. But, the thing is, the street wanted more. The street wanted about 37 billion, and they only managed 35 billion. So it's just a game of expectation.
Yeah.
Wanted to see 37. You gave professionals, analysts that were put said 33. But the street said want 37 or 39, and you managed 35. So, which was, you can say is impressive, and you can say it's not impressive. Impressive in the sense that it shows that the demand for AI continues to grow. Not so impressive because people had very high expectations. And that is why the stock in itself has done about 186% year to date. It's all future expectations that have been built into the current price of the stock. So, but if you drill down a little bit, you'll see their data center revenue growing by 112%, which is really, really huge. And it just goes to solidify the idea that the demand for artificial intelligence is huge and growing at the same time, which is what is ultimately driving the stock price.
You spoke on their data center, right? So we've seen some sort of over-reliance on their data center business. It contributed about 88% to their total revenue, even though they said that not all of their data center sales are chips. That some of it, about 3.1 billion of it, was due to sales of networking parts. But we still see an over-reliance on the data center business. Do you think this is sort of, worrisome?
Well, worrisome on two fronts. So if you look at the data center revenue, Nvidia in itself started out as a chip maker for gaming platforms, and that was how they started out. Before I think around I can't remember when, probably around 2017, 2019, they started working on this whole AI data center. And they saw the future.
Yeah.
I don't think Nvidia even anticipated the sort of demand they are seeing for their data center, which is why the demand is always ahead of the supply, all these years. So it's a good thing for them. Like I would always say, I will take money. If I have a monopoly in a business, I'll take the money first, and then worry about diversifying and looking at other areas to continue to thrive. But I believe it, and I believe in this company so much in the sense that they're a very innovative company, and if a company could sit down and have this type of foresight that they've had, then I believe that we're going to see, as the year progresses, we are going to see other areas. You did mention the networking business, which is from the acquisition of Mellanox in 2019 that they did. So, because all of these data centers needs, you have all of these chips in your data center, you need to network them to make them work optimally. So they figured out investing in that segment is important. So I'm looking at that 3.1 billion that they made from networking, and I'm hoping that they'll continue to grow in that direction, because ultimately at some point you're going to start to see a slowdown in all of these investments from their customers like Microsoft, OpenAI, and all of those guys. So you're going to start to see a slowdown at some point in the investment in this whole AI infrastructure. You're going to see a slowdown. So at that point, we hope that they would have found a new business line to continue to drive their revenue. But it's really, really difficult going forward for them to continue to produce the sort of performance that we're seeing. Growing revenue at 94%. It's like you're doubling your revenue.
Sure.
In fact, previous quarter, there are some quarters in the past that we saw them triple revenue. So will they continue to grow revenue at such high clip? So you're looking at next year, can they do a 60 billion by Q3 next year? Can they do a 60 billion?
Well, the market would expect. So because we have their gaming. They have their gaming business. They have the the professional visualization segment and automotive sales. So with time we'll see how all of those come up to,
but the prospect of those segments growing as high as the data center is very remote. Data center accounts for almost 88% of their revenue. So these guys are contributing very little, and the prospect for growth in those segments is slim, and they have competition. This is the one area where they have little competition. Some people argue that they invented this whole AI space. It's their invention. Everybody, AMD is playing catch up to them. Intel and all of those other guys are playing catch up to Nvidia. So it's their space, and they are mining it well. So, but how long will they continue to mine it?
So when we talk about market expectations, currently Nvidia is doing a market cap of almost 3.5 trillion. So do we think that they would continue to outperform expectations?
Yes, but for me, I have a 5-year runway for Nvidia.
Okay.
I have a
Starting from what year?
Starting from this year, 2024. Okay. So I have them till 2029. Having that ability to continue to grow revenue up to 2029. That is a wrong way I see for them. Because like I said, at some point, a lot of these companies are spending billions and billions of naira investing in this whole AI data center. And at some point, they're going to step back and say, what is in it for us? How we monetize? Let me ask you this question. Let's not even make this a finance thing so much.
Okay.
Now, have you paid for artificial intelligence recently?
Sure.
Have you paid any money? Like, when you use your email, you get to see AI in play.
Yeah.
Suggestions for how to write a better email. I've not seen the iPhone 16 and the AI capabilities. I've not seen, and I don't know if people are going to be made to pay extra.
Extra.
So the whole AI as a product it's not yet monetized fully.
True.
And that is where you look at guys like Palantir and you're impressed with what they've done. I think they're one of the few companies that, to me, have found a way to monetize artificial intelligence. But overall, as a product that a lot of people would have access to, I think Microsoft is doing something along that line with the Office 365. It has advanced AI features, but I think I'm hearing that the rate would go up. So I've not seen that. I think I'm renewing my Microsoft Office subscription later this year. I think this December, December or January. So I would see what the new rate is. But the problem is that most people, many of us, AI is not monetized yet.
We still get a lot of it for free.
Yeah, for free.
Yeah,
so,
true.
And these companies cannot continue to invest billions and billions of money building out this platform that they cannot charge people for. So at some point, we have to sit down and look at the monetization of AI versus the justification for the sort of monies that these guys are voting into the whole AI infrastructure thing. So will they continue? Do they have much room for expansion? I don't know. There's a lot of questions unanswered. Yeah. But to me, I don't see Nvidia having this sort of growth for beyond the next 5 years without identifying new product lines. I don't see that happening.
Okay.
Yeah.
While we're still on the topic of Nvidia, we have their recent AI chip, Blackwell. So most of their end customers have started receiving these. We have Microsoft, Oracle, OpenAI. They've started receiving this. But one of the things that would come into play, which they also spoke about, was demand. So we could see a situation where the demand outpaces supply, because that's seeing some supply constraints coming. So how much do you think investors should worry about this?
Well, for Nvidia, if you look at the demand, it's a good thing in a way.
Yeah.
It's a good thing in a way because I've been speaking about the fact that at some point, these guys are going to slow down with the amount of money they are investing in artificial intelligence. So that they have so much demand that they cannot meet supply means that some of those demands will be carried over into their next fiscal year is 2026.
Yeah.
It means that some of those demands will be carried over into 2027. And if they can keep rolling demands forward to as long as possible, then it's a good thing for them. And that is why I said I have them up to 2029. I have them continue to grow earnings up to 2029 at the current, close to the current clip at which they are growing earnings. But on the other side, you have to think of competition. So the assumption would be if you can't meet your demand, your competitors will
swoop in,
sweep those demands. But it's not easy. Like I said, Nvidia practically invented this whole space.
Yeah.
And nobody is close to them in terms of efficiency, in terms of the quality of chips that they have and the efficiency of their chips. They have the most advanced chip in the market.
Yeah.
And everyone wants Nvidia's chip. So a lot of guys will rather wait than go buy elsewhere, which is a good thing for them. But how long they continue to enjoy that sort of monopoly, we don't know. But it's a good thing that they have this demand and they can roll them forward. But no chip is as advanced as Blackwell in the market today.
Yeah.
None. And hopefully they're going to come up. I think they're working on a new generation of AI architecture. I can't remember the name, but there's a new one they have coming up. So I anticipate that as an investor, I'm not so worried about this just because they practically have no competition. AMD is basically playing catch up. Yeah.
So when we talk about rating, every analyst covering this stock currently has a buy rating on it, right? And if I'm looking at the poll by analysts from S&P Global indicates 48 have a buy rating, 12 have an outperform rating, while only 4 have a hold rating, but there is no sell rating. So, and also the firm has an average price target of $170, $170.44. So these are two good ratings, right? So do you think they are justified?
Well, first of all, as professionals, we all have this bandwagon kind of effect, bandwagon kind of bias and recency bias. Nvidia has been outperforming, and it's difficult to, as an analyst, to actually think otherwise.
Go the opposite direction.
It's difficult to be a contrarian at this point for Nvidia. So, but that said, the sort of upside that we've seen with Nvidia over the last couple of years, I don't think it's realistic as an investor having that sort of expectation. If you have been invested in this stock the last couple of years, you would have seen your wealth grow astronomically.
Sure.
But if you're an investor coming in at this point, I don't believe that there is so much upside at this point. I don't believe there's so much upside. Like you say, the average target is about 170.
Yeah.
How many percent upside is that from the current price? So not much.
Sure.
From 140 to 170. So, but for a long-term investor, it may be all that makes the difference. But if you're having this sort of expectation that you're going to see 186% over the next 1 or 2 years, I don't think it's the sort of expectation that you should have based on the information we have today.
Yeah.
If they find out a new chip that works for a different industry, and I think they have continued to expand their business internationally. There are a couple of customers they now have in Asia, a lot of customers in Europe, and their customer base continues to grow. But how long they continue to grow, it's what I don't know. But at this current valuation, you look at their PE ratio. Their PE ratio is just 48, which is not crazy. Their PE ratio is not crazy. You compare that to the likes of Palantir that has over, I think, about 120 PE ratio.
Yeah.
It's crazy. But Nvidia, I don't think their PE ratio is crazy, just 48. But in terms of upside here out, their market cap is 3.7 trillion. So if you're expecting 100% return, for instance, then you're expecting their market capitalization to reach 7 trillion, which would be a very audacious expectation. To put that into context, no company has hit a 4 trillion valuation yet.
Yeah.
So expecting them to hit 4 trillion, 5, 6, 7, that would be crazy. And they have to be a genius company to do that. But if you have expectation for a 10-20% return over the next 1 year, that would be a fair expectation to have.
That's achievable.
Yeah, that is a fair expectation to have. But if you're coming in at this price and you're looking for 100-200%,
good luck.
Well, it may happen, really, because everything we are saying today is based on what we know.
Sure.
The company may be doing other things that we do not know yet. And I think in a way, they are managing expectation.
True.
For instance, if you look at their forward guidance, they are guiding for about 37.1 billion revenue growth, 37.1 revenue for Q4 2025. That's their current guidance. To me, I think that was part of the reason why their share price kind of dropped after the earnings report. So I think they're going to outperform that.
Yeah.
Obviously, they are managing expectations.
True.
Because the expectation is so high at this point.
Yeah.
And you want to pump the brakes a bit.
So, a second company we need to take a look at, Palo Alto Network. So they also beat analyst expectations. Revenue beat by a small margin of about 0.8%. So their revenue is currently at 2.14 billion. EPS at 1.56 beat analyst expectations by 5.8%. Now, if we look at their sales, which is revenue, is up 13.9% year over year. So, over time, we've seen them implement a platformization strategy, which is sort of designed to switch customers from like point solutions, different sort of solutions, to a suite of the company's products. So I think they ended the quarter with about 1,100 platformized customers. So do we think, is this a trend we can see continue basically?
I think it's a good thing on the part of the company, because back in earlier around February this year, the Palo Alto said they were starting to see some sort of fatigue in spending from their major customers. And by the way, Palo Alto is a cybersecurity company.
Yeah.
So what they do is to help enterprise customers have safer platform. And as we migrate from, as we speak of AI, there are a lot of transactions that are going to be on cloud.
Sure.
Data will be managed on cloud a lot more. So cybersecurity, for me, is one sector that is important if you're looking at the whole AI trend, in terms of the guys who are also providing the infrastructure for AI. So all of this, whether it's Amazon's AWS, all of these guys are going to have strong cybersecurity, if the whole cloud technology, cloud computing thing were to thrive. So in February, they were seeing some sort of fatigue in the spending of their major enterprise customers. And their response to that was to create the platformization strategy, which now allowed a lot of companies to migrate from one solution kind of deal to a suite of solutions from them. And it really paid off, but it came at a price, because they had to sort of offer it free of charge.
Yeah, some products free of charge.
So some of those products free of charge, to avoid customers paying twice for the same product. So they had to take a hit for that. And despite that, they still saw a growth in revenue, and even managed to beat expectations slightly by 0.8%. So it's something that has worked for them. And I think it's going to be the game changer for them going forward, because you have to look at the need for, I did say that at some point, firms will start to look at the kind of money they're spending on all of these solutions. Mm-hmm. So people will want more efficiency, being able to do more with less.
Yeah.
And this type of solution, I think they are, on the call, the company said something like, in future, you're going to have less companies offering this type of one solution type of deals to customers. You're going to see a lot of migrations to firms that offer platforms, suite of solutions to customers, a lot more than we've seen before. And their customer base is growing. They're anticipating to have up to 2,500 customers by 2030, which will be impressive. And with the whole AI thing, I think it's something that will be very, very achievable for them.
Yeah. Mm. So if we had look at their they recently announced a 2-for-1 stock split, which is effective in mid-December. So they are joining the list of companies that have announced stock splits this year. We have the likes of Nvidia, Chipotle, and Walmart. They've done stock splits this year. So currently they are trading at $383, around that range. They are trading around that. So of course, if we see a 2-for-1 stock splits, we'll see them trading at do the math.
About 190 something.
Yes, 190 something. So how do we think this would impact their price going forward?
I mean, in terms from a valuation point of view, stock splits don't change anything for the company.
Yeah.
It won't grow their revenue. It will make them more efficient. But why a lot of companies do implement this stock split is to give access to more retail investors. And you'd agree with me that currently you have a lot of interest from retail investors. So when companies do implement this type of corporate decisions, is to attract more retail investors,
Yeah.
which would impact their share price.
It would also lead to some sort of increased trading activity on their stocks.
Yeah, there'll be more interest because now not many people would want to buy Palo Alto at 300 and something.
Yeah.
Not many people want to buy, but if the price comes down to 190 something, you have a lot more retail investors willing to buy at that price. But ultimately, it doesn't affect the value of the company. But in terms of market sentiments, that could change positively for the company. Most firms, you see their share price do well after implementation of stock splits like this. It's always, it favors existing shareholders more, almost always.
Yeah. So if you look at their valuation, with their current valuation, is it a buy, sell, or hold?
Well, I'd say to me, Palo Alto will be a buy at this point in time, but not a strong buy.
Okay.
A buy in the sense that you have this whole AI-driven demand for cybersecurity will continue to surge, and I think the platformization strategy they have adopted would be a tailwind for the company going forward. So it's a buy for me, but not a very strong buy.
Yeah. All right. So the next company we'll move on to is Medtronic. Now, Medtronic, they also surpassed analyst estimates. Revenue surpassed by 1.57 it stood at 8.4 billion. EPS surpassed by a margin of 0.8%. So their current EPS is at 1.26%. Now, despite this strong performance, relative, but despite this performance across their several segments, they have their cardiovascular, neuroscience, medical, surgical, diabetes. Those are the segments. The company is still in that mid-single digit revenue growth, and it has an outsized SG&A pending. So, I mean, if we look at this trend, this trend is putting some sort of downward pressure on their bottom line. How sustainable do we think it is?
Well, like you said, they have seen impressive performance with different segments, but the thing is, diabetes, for instance, grew by 12.4%, but contributed only $690 million, which is a very insignificant part of their total revenue. And most of their revenue comes from cardiovascular segment, which grew by just 6.1%. Neuroscience grew by 7.1%. And then medical surgical grew by 1.2%. So, but if you're thinking about a company like Medtronic that sells medical devices for different chronic diseases, they can't simply grow revenue at double digit. It's difficult to grow revenue at double digit because that segment has a lot of tailwinds. For one, there's a lot of competition. They have competition from the likes of Abbott Laboratories. And also you factor in the possibility or the ongoing trade wars and the possibility that it's likely to escalate with the coming of Donald Trump, because most of these devices are exported.
Yeah.
They have segments, they operate internationally. So, and for a company that operates internationally, you're going to have headwinds from currency fluctuations, and then from these tariffs, increased tariffs that these countries will implement. So all of that will not bode well for a company like Medtronic. So it's going to be an uphill task for them to go out and grow revenue at, say, 12% overall. It's going to be very, very difficult for them. And I think in that respect, what I think they may be able to do as an option will be to, consider some type of M&A, some type of mergers and acquisition in sectors that could help them see that double-digit growth that seemed to elude them for so long, But for what is worth, for a company like Medtronic that is focused on medical devices strictly, it's an impressive result. It's an impressive result. But expecting them to, turn around and have that double-digit revenue growth may be difficult. But they have excellent, their net profit margin improved to 15.1% from 11.4%. Their operating margin improved to 19.1 from 16.8. The net cash flow provided by operating activities stood at 1.9 billion compared to 1.5 billion previously. Free cash flow improved to 721 billion. Improved from 721 million to 1.02 billion for the current quarter, and that is impressive. That is impressive. But in terms of every other thing, taking into account revenue growth, is going to be difficult for them to turn it around.
Yeah. I mean, the markets, it's obvious the markets expected more because they've been down 1.858% for the week. And if you look at their year-to-date performance, is at 4.65%, which, of course, if you compare it to the S&P 500 performance, which is up 25% year-to-date, it's still a far cry. Mm-hmm. So, and currently their forward PE is 15.81. Now, with all of this, do you think this is a buy signal?
It depends. If you are a low-risk investor, you can look at this type of stock. You're not going to lose money investing in Medtronic.
Yeah.
But you're also not going to make a lot of money investing in this type of company. The problem is the pace, the rate of growth. I don't see it having that much volatility going forward, but you're also not going to make a whole lot of money investing in this type of stuff. Yeah. The company has had a lot of headwinds it's faced over the last couple of quarters, which is why you are seeing the price where it is today. But the PE ratio is good, and it makes a case to invest. But by and large, it depends on your goal. If you are a high growth investor, then this is not the type of stock you should be looking at. But if you're a very conservative investor who wants stability, then you may consider Medtronic.
Yeah. I think the last company we have to look at that published their earnings reports is Snowflakes. Now, Snowflakes also, so it seems like there's a trend here where all the companies we're discussing today beat analyst expectations.
Yeah, but this one beat expectation by far, and unexpectedly.
True.
Unexpectedly.
That's true. So we saw their revenue, it beats estimates by 4.9%. So their current revenue sits at $942 million. EPS, it beats by estimates by a whole 31.7%. So I think following these results, these impressive results, we saw their stocks rise by about 31.4% for the week. Now, what do you think was most impressive about this result?
A lot of impressive points from this result. Snowflake, for one, has faced a lot of headwinds over the last couple of quarters. I did speak about Palo Alto and the fact that back in February, they said they were seeing some sort of fatigue from spending fatigue from most of their customer. Snowflake is a company that also was in a similar hole earlier on, and somehow they've managed to turn it around. Their revenue grew astronomically, as you said, by 28% from Q3 2024 to Q3 2025. Impressive growth in revenue. But the performance that stood out to me, one, is their remaining performance obligation, which improved to 5.7 billion, their RPO. So, with these software companies, when you sign up a deal with them, the deal is worth an amount of money.
Yeah.
It's worth an amount of money. And then they don't recognize the whole. Let's say you sign a $1 million deal with them today. Not all of the 1 million is recognized as revenue same day. It's as they use that service that they recognize. So that their remaining performance obligation is improving is an indication that they are signing on more deals.
Yeah.
And then the other thing you look at is their net revenue retention rate, which is currently at 127. And what this means is that what net revenue retention rate measures is how many customers did you have last year that have renewed this year. And when you have a number that is higher than 100%, it means that the customers you had on the aggregate from the previous year are spending more this year. So if on the aggregate, the customers you had last year spent 100 million, if you have a net revenue retention rate of 127%, it means that this year they have increased their spending from 100 million to 127 million, which is also what you want to see as a software company. And their customers with 1 million and above deals grew to 542, which was a 25% increase from last year. Their total customers currently stand at 10,618. I think the market expected their total customers to grow to 10,608. So they outperformed in that segment. This quarter alone, they added 369 customers. And this company has a very unique type of business in the sense that they are in the cloud storage business. They are competing with Amazon, Google, and Google is Alphabet, and Microsoft. They are competing with these guys, but at the same time, they are cooperating with them in the sense that they use the cloud services provided by these guys. They use Amazon's AWS. I think that's the major platform they use. They use Microsoft's Azure, and then they also use Alphabet's cloud services. So somehow they're able to both compete and cooperate with these guys at the same time, which is helping them, strike those partnerships, and while at the same time finding a way to use their platforms to continue to grow their business. So I think the most impressive thing is the fact that they're able to turn around their business, and then we're at this point where I think the share price rose almost 32% for the previous week. No one saw this result coming. Actually, no one saw it coming. And they operate in a space where the demand is expected to only grow. The demand for cloud storage would only grow, especially with migration from on-site storage to cloud storage. I mean, virtually every company, every firm in the world today have their data stored in cloud.
Yeah.
Very few companies are still operating with their storage on site. Yeah. Even the smallest businesses today are migrating to cloud. So they operate in a segment where there's a lot of demand for their services, as much as there's competition. And I think they're just doing fine in terms. And I think they have a this same platformization strategy adopted by Palo Alto in the delivery of the service.
Yeah, I think another thing, point of note is that they just recently acquired a platform, Datavolo. So Datavolo is sort of a unification platform. So it automates their data workflows for both structured and unstructured data. And something to note there is that given that their federal government sector, the federal government sector remains a very small part of the Snowflake business. And Datavolo is used in a lot of federal organizations. So we could see some sort of this platform sort of strengthen Snowflake's position in the public sector.
I mean, that's how companies can break into segments where they are weak.
Yes.
You go acquire somebody who is already playing in that field. I don't think I've heard of that
Datavolo.
I
hadn't heard of it until I saw that these guys just acquired it. So yeah, so hopefully this helps them break into the public sector and hopefully increase their revenue spread.
But I think it's a company to keep an eye on. There are a few things that obviously I don't like companies that are making loss.
Nobody likes companies making loss.
But if you're a technology company, this company, I think they just got listed on the US Stock Exchange in 2000. So it's a very young company.
Yeah.
So they're at the point where they're still ramping up demand for their products. And as a young company, there are periods where you make losses, So, but for me, I always prefer a company that is already making profit and growing free cash flow, as an investment case.
Yeah.
But obviously, with the direction of their revenue growth and the sort of acquisition they've been making and partnerships with some of these bigger players in the cloud storage space, I see their revenue to grow from here out, So, but I'm also looking at their cost of revenue. It grew at 40.16%. So you want to see that number come down a little bit. I don't like this figure. Your revenue is growing at 28.3. Your cost of revenue should not be growing at 40.
Yeah.
But because of the stage they are in their growth curve, this sort of scenario will be expected. But definitely is a company to keep an eye on, and we have it on our radar. We'll continue to cover it and update.
I think they've been sort of going through some cost management initiatives, actually. So removing some redundant management layers and sort of centralizing teams. So we could see that play out. Their initiatives start to play out maybe from upcoming reports.
Okay, hopefully we'll see that happen. But it's what they have to do to turn things around.
Okay. Yeah. So for earnings for this week, CrowdStrike, we mentioned it last week, but they moved the date, so we'll see their reports come out this week.
Did they move the date?
I think so. I think so. I stand to be corrected.
Okay.
I stand to be corrected. That. So I think that's the only company we're looking out for. Is there any other one?
No, none of the companies that we cover is reporting next week. There are a couple of others reporting next week, but we also have the MPC meeting holding this week.
Yes.
MPC meeting is holding this week, and we're looking to see what happens with the central bank. Will they raise rates again?
Yeah, well, they've maintained maintained a hawkish stance, given that inflation is currently at 33.88%. Yeah, So maybe they might keep
No,
rates.
right, likely they will raise rates.
Yeah.
Yeah, there's no brainer because you're looking at inflation, as you mentioned, at 33.8%,
Yeah.
which I think 2 quarters ago we saw a decline in inflation. Oh, sorry, about 2 months ago.
2 months ago.
We saw a decline in inflation. And then after the last MPC, we saw a rise, consecutive rise. I think this is the second time inflation is rising. And then you consider that we still have foreign exchange pressure,
Yeah.
on the Naira. The Naira has continued to depreciate, and the official market is almost 1,700 as we speak. And then in the parallel market, I think we are doing something around 1,750
Yeah.
or thereabout. And this has been a concern for CBN. They want to see the exchange rate come down. Petrol price has also been rising. I think the last time I bought was 1,120 was what I bought on Sunday.
Yeah.
Last Sunday. Was it last Sunday? Yesterday. Yes, yesterday I bought 1,120. So we still have pressure on the inflationary pressure. And you consider that we're entering the month of December, where prices naturally would
Just
go up.
Yeah.
So when you account for all of that, one, inflation and the fact that you expect inflation to even be higher this month, exchange rate pressure, and the CBN's focus on maintaining a positive real rate of return. So if you look at the auction results that we highlighted at the beginning, bond auction up, bond rates up, treasury bill rates also up. For me, that's a signal that the CBN will likely raise rates. Just to make sure that the real rate of return, which is the return you are making after adjusting for inflation is positive. So if the cut rate or hold rate steady, with the level of inflation, you're likely going to see a negative real rate of return. And the CBN also wants to keep foreign portfolio investors attracted to the Nigerian market. And you can't maintain that in a scenario where you see inflation going up and you are lowering rates. So it's at the end of the day, you're going to get a negative real rate of return, which will spook these foreign investors that the CBN loves so much. So I think they're going to raise rates anywhere between 0 points. Maybe I don't like prediction. I hate prediction.
Okay, let me try predicting. let me predict. So we could see maybe by 25 to 50 bips.
Are you guessing or
no? Not
or you
guessing.
have some insider information?
Not insider information. Just looking at the trend.
But I think they're going to do at least 50 basis points. At least. It could be anything higher than that. I won't be surprised if they do 100 basis point interest rate raise. They can decide to be real aggressive.
So you still predicted.
Because you see, there's concern that Trump's policies would actually push inflation higher. Now, whether those concerns are justified or not is a case for discussion at some other point in time. But that is what it is. There's concern that Trump's policies will drive inflation back up. So I don't think the CBN at this point will be so confident in terms of the inflation direction for the advanced economy. So I think they're going to tread cautiously, and their caution will be less raise rate to stay on the safe side.
Yeah. So by tomorrow, Tuesday, we'll learn what that decision is.
Yes.
So I think we've come to the end of this session.
Yeah, and for our listeners, it's still me, Nathan, Casey Nwokoro. I mean, we hardly introduce ourselves on this show, and I'm here with Chidalu, HM.
Chidalu.
It's always our pleasure to do this every Monday morning and to keep you up to date with events in the Nigerian and global capital market. You can support us and let us know that you listen to this show by commenting in the comment section below And by letting us know your thoughts, if there are things you want us to discuss, please do well to let us know, and we'll try our best to keep meeting up and surpassing your expectations. Until next week.